Okay, so let's take a few minutes to talk about some performance evaluation and control tools that management can use to evaluate performance. When a company grows, it's impossible for a single person to manage the entire organization's operations. And companies that decentralize split their operations into different operating segments. Top management delegates decision-making responsibility to the segment managers. Top management determines the type of decentralization that best suits the company's strategy. For example, decentralization may be based on geographic area, product line, distribution channel, customer base, or business function. Most growing companies decentralize out of necessity. However, decentralization provides many potential benefits. It frees up top management's time by delegating responsibility for daily operations to segment managers. Top management can concentrate on long-term strategic planning and higher-level decisions that affect the entire company. It encourages the use of expert knowledge. Decentralization allows top management to hire the expertise in each business segment needs to excel in specific operations. Improves customer relations. Segment managers focus on just one segment of the company, allowing them to maintain close contact with important customers and suppliers. Provides training. Decentralization also provides segment managers with training and experience necessary to become effective top managers. And it improves motivation and retention. Empowering segment managers to make decisions increases managers' motivation and job satisfaction, which often improves job performance and job retention. Many advantages of decentralization outweigh the disadvantages. However, decentralization can cause potential problems, including those outlined here. Potential duplication of costs. Decentralization may cause a company to duplicate certain costs or assets. And potential problems achieving goal congruence. So goal congruence occurs when the goals of the segment managers align with the goals of top management. So once a company decentralizes operations, top management is no longer involved in running the day-to-day operations of the segments. Performance evaluation systems provide upper management with feedback it needs to maintain control over the entire organization, even though it has delegated responsibility and decision-making authority to segment managers. To be effective, performance evaluation systems should clearly communicate expectations, provide benchmarks that promote goal congruence and coordination between segments, and motivate segment managers, possibly through paying bonus incentives to managers who achieve performance targets. Responsibility accounting, discussed next, is an integral part of most companies' performance evaluation systems. So a responsibility center is part of an organization whose manager is accountable for planning and controlling certain activities. Lower-level managers are often responsible for budgeting and controlling costs of a single value chain function. For example, one manager might be responsible for planning and controlling the production at a single plant, while another is responsible for planning and controlling the distribution of the product to the customers. Lower-level managers report to higher-level managers who have broader responsibilities. Responsibility accounting is a system for evaluating the performance of each responsibility center and its manager. Responsibility accounting performance reports compare plans, which are budgets, with actual results for each center. Supervisors then evaluate how well each manager controlled the operations for which he or she was responsible. So here's some conditions for using responsibility accounting. Costs and revenues can be directly associated with the specific level of management responsibility, so you only want to hold people accountable for things that they can manage. The costs and revenues can be controlled by employees at the level of responsibility with which they are associated. And budgeted data can be developed for evaluating the manager's effectiveness in controlling the costs and revenues. Okay, so we have 4 types of responsibility centers. You can see here: cost center, revenue center, profit center, and investment center. So a cost center, in a cost center, managers are only accountable for costs. Examples here would be a manufacturing plant. In a revenue center, managers are accountable primarily for revenues. Many times, revenue centers are sales territories, such as a geographic area within the country. For example, the company's Southeast sales region. Managers of revenue centers may also be responsible for the costs of their own sales operations. Revenue center performance reports compare actual revenues to budgeted revenues. Now, in a profit center, managers are accountable for both revenues and costs, therefore profits. Superiors evaluate managers' performance by comparing actual revenues, expenses, and profits to the budget. In an investment center, managers are responsible for generating revenues, controlling costs, and efficiently managing the division's assets. Investment centers are generally large divisions of a corporation, and investment centers are treated almost as if they were standalone companies. Division managers generally have broad responsibility, including deciding how to use assets, and as a result, managers are held responsible for generating as much profit as they can with those assets. So here's a nice little summary. It excludes the revenue center, but shows you the differences between the three types. So the cost center here you can see is responsible for expenses. The profit center is responsible for expenses and revenues, whereas an investment center typically is responsible for revenues, expenses, and return on investment. So if we talk about budgetary control, what we're talking about is essentially developing a budget, analyzing differences between the actual and the budget, taking corrective action, and then modifying future plans. And then the whole cycle starts over again. And that's what we're going to be talking about a lot today. A performance report compares actual revenues and expenses against budgeted figures. So the difference between actual and budgeted is known as a variance. And the specific figures included on each performance report will depend on the type of responsibility center being evaluated. For example, the performance reports of cost centers will only include costs incurred within the center. Managers use a technique called management by exception when analyzing performance reports. Management by exception means that managers will only investigate budgeted variances that are relatively large. Managers do the same thing. If the actual costs or revenues are close to budget, they assume operations are in control. However, if the variance between budget and actual is relatively large, they'll investigate the cause of the variance. Managers often have a decision rule for variance investigation that is expressed as a percentage, dollar amount, or a combination of the two. So here is an example of management by exception. Again, it's just differences between actual and planned results, and we're going to only investigate material and controllable exceptions. So ones that are significantly different from budgeted, either over or under, and that are controllable by the particular manager. Here we have a partial performance report for a revenue center, and you can see we've got actual versus budgeted sales and then the variance, and they're telling you if it's an unfavorable variance. In this case, budgeted sales were 2.4 million. Actual sales came in at 2.376 million, and since that's less than budgeted, that's an unfavorable variance. And then they can break that into percentages as well. Although a favorable variance are typically good news for the company, the same interpretation can be misleading when it comes to expense variances. Be careful not to interpret favorable expense variances as good and unfavorable expense variances as bad. Here's an example of a performance report of a profit and investment center, which includes both revenues and expenses. Performance reports are often presented in the contribution margin format rather than the traditional income statement format. These reports often include a line item called segment margin. A segment margin is the operating income generated by a profit or investment center before subtracting common fixed costs that have been allocated to the center. So you can see here the segment margin, actual versus budgeted, and a $10 favorable variance. Now if you look at this example, you can see that fixed expenses are separated into two categories. We've got direct fixed expenses. Those include that can be traced directly to the profit center, like advertising for an item. And then you have common fixed expenses, and those include fixed expenses that cannot be traced directly to the profit center. These are fixed expenses incurred by the overarching investment center that have been allocated among the different profit centers in the division. For example, these allocated costs may include the division's costs of providing a common computer information system, human resources department, payroll, legal department, typically those home office type expenses that you might see. And by sharing these services, the different product lines avoid duplication of the costs and assets that would otherwise need to be maintained by the individual profit centers. Because the manager of the profit center has little or no control over the allocation of the common fixed expenses, he or she should not be held responsible for them. Therefore, the manager is typically held responsible for the center segment margin, not its operating income. So the performance reports for each level of management flow up to the top of the company. The operating income from each profit center flows into the performance report for the investment center. The operating income from each investment center flows up to the performance report for the entire company. Costs incurred by the corporate headquarters are treated as a cost center and are typically not allocated to any of the divisions. In addition, performance reports related to the cost and revenue centers under each profit center would probably flow up to the profit center. Responsibility accounting assigns managers responsibility for their segment's performance, but superiors should not misuse the system to erroneously find fault or place blame. Some variances are controllable while others are not. For example, managers have no control over the general economic conditions of the country that may reduce sales. Managers need to carefully consider the causes of large variances so they can focus on improving those that are controllable, while developing strategies for minimizing the risk associated with uncontrollable variances. As discussed earlier, investment centers are typically large divisions of a company, and the duties of an investment center manager are similar to those of a CEO of an entire company. Investment center managers are responsible for both generating profit and making the best use of the investment center's assets. So in this section, we'll take a look at the two performance measures most commonly used to assess the performance of investment centers: return on investment and residual income. To adequately evaluate an investment center's financial performance, top managers assess each division's operating income in relation to its assets. They typically do so by calculating the division's return on investment or residual income. So when top management decides how to invest excess funds, they often consider each division's ROI, which is return on investment. A division with a higher ROI is more likely to receive extra funds because it has a track record of providing a higher return on the investment. In addition to comparing ROI across divisions, management also compares a division's ROI across time to determine whether the division is becoming more or less profitable. In addition to benchmarking ROI over time, management often benchmarks divisional ROI with other companies in the same industry to determine how each division is performing compared to its competitors. So you can see here we calculate ROI by taking operating income and dividing that by total assets. Now, to determine what is driving a division's ROI, management often restates the ROI equation in its expanded form. Notice that sales or sales revenue is incorporated in the denominator of the first term and the numerator of the second term. When the two terms are multiplied together, revenue cancels out, leaving the original ROI formula. So why do managers rewrite the ROI formula in this way? Because it helps them better understand how they can improve their ROI. The first term in the expanded equation is sales margin, operating income divided by sales, which focuses on profitability by showing how much operating income the division earns on every dollar of sales revenue. The second term, capital turnover, focuses on how efficiently the division uses its assets to generate sales revenue. Now, similar to the ROI, the residual income calculation is based on both the division's operating income and its assets, thereby measuring the division's profitability with respect to the size of its assets. However, the residual income calculation incorporates one more important piece of information: management's target rate of return. The target rate of return is the minimum acceptable rate of return that top management expects the division to earn with its assets. Management's targeted rate of return is based on many factors. Some of these factors may include the risk level of the division's business, interest rates, investor expectations, return being earned by other divisions, general economic conditions. All these factors can change over time. Management's target rate of return will also change. So residual income determines whether the division has created any excess or residual income above and beyond management's expectations. Notice in this equation that RI compares the division's actual operating income with the minimum operating income that top management expects given the size of the division's assets. A positive RI means that the division's operating income exceeds top management's target rate of return. A negative RI means the division is not meeting the target rate of return. Because the ROI calculation already shows managers whether or not the division has reached the targeted rate of return, why do some companies prefer using residual income rather than ROI? And the answer is because the residual income often leads to better goal congruence. So management must make some decisions before calculating RI and ROI, and most of these decisions revolve around how to measure the assets used in the ROI and RI calculations. Which balance sheet date should we use? Because total assets will differ between the beginning of the period and the end of the period, companies must choose a particular point in time for measuring assets. Some companies use the average of the beginning and the end of the year. And should we include all the assets? Well, management must decide if it wants to include all the assets in the total asset figure. Some firms do not include non-productive assets. And should we use gross book value or net book value? Gross book value is the historical cost of the assets. Net is the historical cost less accumulated depreciation. Using the net book value of assets has a definite drawback. Because of depreciation, the net book value of assets continues to decrease over time until assets are fully depreciated. As a result, ROI and RI get larger over time simply because of depreciation rather than from actual improvements in operations. In general, calculating ROI based on the net book value of assets gives managers incentive to continue using old, outdated equipment because of the asset value keeps decreasing. Thus, to create goal congruence, some firms prefer calculating ROI based on gross book value of assets or even based on an asset's current replacement cost rather than the asset's net book value. Should we make other adjustments to income or assets? Some companies use a modified residual income calculation referred to as economic value added. To arrive at EVA, managers must make several adjustments to the way income and assets are measured in the residual income formula. For example, research and development expenses are often added back to income, not viewed as expenses, while total assets are usually reduced by the company's current liabilities. Now, some limitations of financial performance measurement. One serious drawback is the short-term focus. Companies usually prepare performance reports and calculate ROI and RI using a time frame of 1 year or less. If upper management uses a short time frame, division managers have an incentive to tackle or to take actions that will lead to an immediate increase in these measures, even if such actions may not be in the company's long-term interest, such as cutting back on R&D or advertising. On the other hand, many potentially positive actions may take longer than 1 year to generate income at the targeted level. Many product lifestyles start slow and even incur losses in the early stages before generating a profit. If managers are measured on short-term financial performance only, they may be hesitant to introduce new products that may take time to generate acceptable profits. As a potential remedy, management can measure financial performance using a longer time horizon, such as 3 to 5 years.